Hi everyone, for today's video, I will going to share with you all about financial statements, its components users, and I will also give some examples. So before anything else, let's define first what is financial statements. The word financial statements refers to a collection of reports produced by an organization's accounting system. These reports are intended to provide details about the entity. Now, let's proceed to the components of financial statements. Financial statement components are the building blocks that come together to shape the financial statements and help determining the financial health of a company. Income statement, balance sheet, cash flow statement, and shareholders' equity statement are the four financial statements that make up a company. Each part serves a role and aids in the comprehension of the business financial affairs in a conscious manner. Let's explain first the first component, which is the balance sheet. The balance sheet shows the company's financial conditions at a given point in time. It's also known as a financial position statement, a financial condition statement, or a position statement. It portrays the assets held by the company on the one hand, as well as the source of funds used by the company to retain those assets in the form of capital investments and liabilities insured by the company on the other. In a nutshell, the balance sheet demonstrates how revenue is made available to the company's business and how the money is spent. Balance sheet consists of three elements. First, asset. These are the resources that the company has control. They may be listed as tangible assets or intangible assets, as well as current assets, those that can be turned into cash within a year, or non-current assets which are not converted into cash within a year. The second one is liabilities. The amounts owed to lenders and other creditors are listed here. Liabilities are further divided into current liabilities, those due within a year, and non-current liabilities, those due after a year, such as term loans, debentures, and so on, which are not payable within a year. Lastly is owner's equity. Often known as the owner's capital investment, it represents an entity remaining interest in its net assets after deducting its liabilities. It's also an indication that the promoter has some skin in the game. Example, business. This is an example of a balance sheet. For each transaction in a balance sheet, the fundamental accounting equation holds. Assets equal liabilities plus owner's equity. Second, let's proceed to the second component, the income statement. The income statement includes revenue, which includes all cash flows from the manufacturing of products and rendering of services. Expenses, which includes all cash outflows from the manufacturing of goods and rendering of services. And all profits and losses that are not attributable in the ordinary course of business. Excess of revenues over expenses results in profit and vice versa, resulting in loss for the business during the period. Under IFRS, income statement also comprises of other comprehensive income, which consists all changes in equity except for shareholders' transactions, and such can be presented together as a single statement. However, As per as GAAP guidelines, Statement of Comprehensive Income forms part of Statement of Change in Equity. This is an example of income statement. Next component is the Statement of Change in Equity. This is the example. This statement is one of the financial statement components that reports the number and causes of changes in equity, shareholders' investment in the company over time. It summarizes the adjustments in capital and reserves attributable to the company's equity holders over the accounting period, as well as all year-to-year increases and decreases when adjusted with the beginning balance results in ending balance. The statement reconciles the starting and ending balances of each equity account, including capital stock, additional paid-in capital, retained earnings, and accrued other comprehensive profits, and contains transactions with shareholders. The statement depicts how the equity composition, share capital, other reserves, and retained earnings has changed over the course of the year. Last component is the cash flow. This statement depicts the change in the company's financial position as a result of cash flows into and out of the company. The key purpose for preparing a cash flow statement is to supplement the income statement and statement of financial condition, which do not contain adequate detail regarding adjustments in cash balances. The cash flow statement fills in the gaps, allowing different business stakeholders to consider the sources and uses of cash. The cash flow statement is divided into three sections. First, cash flow from operating activities. It begins with operating profit and reconciles it to cash flow. Second, cash flow from investing activities. It covers all long-term assets purchase, sales, and other investments that are not included in cash equivalent. Interest and dividend payments from assets are also included. Lastly, cash flow from financing activities. It takes into account changes in equity capital as well as borrowings. It includes the payment of dividends to the company's shareholders, cash flows from the debt payments, and new borrowing and stock insurance. Now is the users of financial statement. Accounting's goals is to provide users with knowledge they can use to make decisions. But who are these? Users of financial statements. What data do they require? Owners and investors, management, vendors, lenders, staff, consumers, the government, and the general public are all users of accounting data. So first, number 1, owners and investors. Corporation stockholders need financial data in order to make decisions about their assets, shares of stock, such as whether to keep, sell, or buy more. Prospective investors need details in order to evaluate the company's success and profitability. Similarly, small business owners need financial data in order to assess if their business is profitable and whether they can continue, expand, or close. Second, management. The owners of small businesses may be part of the management team. In large companies, however, management is normally made up of hired professionals who are charged with running the entire company or a portion of it. They serve as the owner's agents. Managers, whether they are the owners or hired, must make economic choices on a daily basis. For example, how much can we spend on supplies? Is there enough money? How much money did we make the previous year? Did we achieve our objectives All of these, as well as several other issues and business decisions, necessitate accounting data analysis. Number 3. Lenders. Banks and other financial institutions that lend money are interested in a company's ability to pay its debts and become due. Number 4. Trade creditors or suppliers. Trade creditors and vendors, including lenders, are concerned with the company's ability to meet its commitments as they fall due. They are concerned, however, about the company's liquidity or its ability to meet short-term obligations. Number 5. Government. For taxation and regulatory purposes, state governing bodies, especially the MAX authorities, are interested in the entity's financial details. Taxes are calculated using the outcomes of operations as well as other tax bases. In general, the state wants to know how much money the taxpayer makes in order to calculate the tax owed. Number 6. Employees. Employees are care about the company's sustainability and long-term prosperity. They're interested in the company's ability to pay wages and offer benefits to employees. They may also be involved in the company's financial status and results in order to evaluate expansion prospects and job opportunities. So, those are some uses of the financial statements. In conclusion, the most valuable information about an organization is found in its financial statements. It provides a good picture of the company's financial situation and results, which can be contrasted to the rivals and peers. As a result, as stated in the paper, different consumers read and comprehend the company's financial statement for their own purposes. Each portion of the financial statements serves a distinct and useful role in assisting various stakeholders in better understanding the financial health of the business and making better decisions, whether they can investors or lenders. That's all, guys, and thank you for your listening. I hope you understand my report. Get blessed.